Hello guys, thank you so much for joining in. Welcome to the sparring session for FAR 1. Now FAR 1 is fundamentals of accounting. Now in this we have two sessions. For FAR 1 we'll have two sessions. The first one where we'll discuss fundamentals of accounting or basics of accounting. And in the second session we'll talk about standard setting bodies, standards, qualitative characteristics of financial statements. So these are the two sessions we'll have in FAR 1. And we'll get started with FAR curriculum officially. Now, the first session is very, very, very important. And I think everybody must understand it. This is not specifically, the session we are having today, it's not specifically a part of the blueprint. But you cannot understand FAR without understanding this. So it is a part of the blueprint in that aspect. Now, from FAR 2 to through FAR 29, I'll never teach you what is a journal, how to write journals. I'll never teach you how a T account works. I'll never teach you what are accounting principles. But I'll use all of it. I'll use all of it, right? So we are discussing those basics here. So think of it like accounting 101. Now, for most of you who had accounting in undergrad, in school, let's just say you studied accounting 10, 15, 12 years back, this will be a refresher. But for people who have never studied accounting, it's even more essential that you go through this. And this might not be enough as well. So you might need to hunt for additional resources online so that you can catch up. You can catch up. So what we are doing here is giving you the basics of accounting, which you must know to discuss FAR. Because the entire FAR curriculum starts with an assumption that you must know these basics. What is a journal? What is a ledger? How to prepare journals? How to prepare T accounts? What is a trial balance? It starts with the assumption. Now, I am putting some substance to that assumption that, okay, hey, if I'm giving that if you don't know this, let's teach you the basics here. So that's what we'll be discussing for the next 1.5 hours. It's accounting 101. We'll talk about the basics of accounting. Very, very important. Not specifically a part of the blueprint, but important enough that you need to go through this so that you understand the rest of the FAR. You'll use what we study today is something which you will use in the entire FAR curriculum. And therefore, very, very, very important. Now, let's get started. Now, let's try to understand what accounting is. Now, accounting is nothing but giving information to your stakeholders about what is going on. What is accounting? It's giving information, financial information to your stakeholders about what is going on in the company. That's the objective of accounting. We are giving information, right? Think about it. It's very simple. You give your kids, let's say as kids, when you received money from your parents, right? You received, let's say, $100. You would go back and tell them where did you spend the $100, right? Or if you give money to your kids, you'll often ask them that, hey, where did you spend this? You're basically taking an accounting from them. That's the same thing. You've invested money in a company. Now you want to understand what they did with your money. What have they've been doing with the business. So you're taking an accounting from them. That's the objective of accounting, to give financial information to stakeholders about what is going on in the company. Now, think about it. There are so many companies. Each company can have their own accounting method, can have their own accounting style, which will create a challenge, right? So to understand the books, do we need to understand the reporting and accounting style for each and every company, which might be very unique? How do you compare these companies? Right? So there should be some uniformity. There should be some uniformity in accounting, so that all companies account and keep a track of their records the same way. And for these uniformity, to ensure this uniformity, we have something called generally accepted accounting principles. Generally accepted accounting principles. Now, these are the common sets of principles we have accepted that you will use these while making our books. We'll use this. So these are generally accepted. That's why generally accepted accounting principles. These are the principles based on which we'll maintain our books, and these are generally accepted. Right now, they are the generally accepted principles across the world, across the world. And let's discuss some of these important principles. So the first one is accrual principle. And accrual principle goes together with matching principle, They are very closely related. Now, what is accrual principle? Accrual principle states that, see, think about it. Accrual principle states that we will maintain our books on accrual basis and not on cash basis, which implies income is recognized in the period we earn it, in the period earned, irrespective of when cash is received. So let's just say you made a sale in 2025. You collected cash in 2026. But when will the sale be recognized? Income is recognized in 2025. Doesn't matter when cash is received. We are not following cash basis of accounting. We are following accrual basis of accounting. That means we'll follow what has happened in the year. Cash might come in later. That's fine. So that's what accrual principle says. Similarly, expense is recognized. Expense is recognized in the period incurred, irrespective of when cash is paid. When cash is paid. So you rented an office building. Rented office building for 2025, in 2025. But rent paid in 2026. Rent is paid in 2026. When is expense recognized? We haven't paid rent yet. But when will the expense be recognized? In 2025, even though we haven't paid it. Why? Because we have used the premises this year. It was incurred for this year. Similarly, let's just say you paid insurance in advance. For 2026, 2027, in 2025. Insurance for 26 and 27 was paid in 2025. Will the expense be recognized? No, expense will not be recognized. Because does it pertain to this period? No, it doesn't. Expense will not be recognized. Because it doesn't pertain to this period. It will be recognized in 2026 and in 2027. 2026 and 2027 is when expenses recognized, not in 2025. That's what accrual principle is. It doesn't matter when cash is coming in or cash is going out. Income is recognized when we have earned it, and expense is recognized when we have incurred it, when we've expended it. And this is very closely related to matching principle. Now, matching principle states income and revenues are matched to the period in which benefits are provided. Similarly, expenses and losses are matched to the period in which benefits are received. Let's understand this. And it's very closely associated with accrual principle. Income is matched to the period in which benefits are provided. Income is expended to the period in which benefits are provided, are matched to the period. We're matching it to the period. So let's just say you will use Ninja CPA review from July 25 to June 26. To June 26. Sorry, June 2026. Let me just change the period. July 2025 to June 2026. That's when you'll be using the Ninja CPA review. You have paid the money. You have paid the money. Let's just say you have paid $1,000. Let's just say you paid $1,000. Let's assume that. Now, in this case, when are you using it? You're using for 6 months in 2025, 6 months in 2025, and 6 months in 2026. Right? You're using the subscription. Subscription is used for half 6 months in 2025 and 6 months in 2026. You paid, let's assume you paid cash in advance. That's not our model, but let's assume you paid cash in advance. Cash was paid $1,000. Now, what will be the income will be recognized? What will be the income will be recognized? Income recognized in 2025 will be half for 6 months, half, and the other half will be recognized in 2026. Because of matching principle, income and revenues are matched to the period in which benefits are provided. When are we providing the benefit? In 2026. We are providing half of the benefits in 2026, such that half of the revenue would be recognized in 2026. Doesn't matter when cash is received. See, that's why they're closely related. They're both saying the same thing. They're both saying the same thing. They're both saying the same thing. Income is recognized in the period in which they are earned, 2026, regardless of when cash is received in 2025. Doesn't matter. Second thing, what is matching saying? Income and revenue would be matched to the period to which they pertain, in which we are providing the benefits. Doesn't matter when cash is coming in. So when are we providing the benefits? In 2026. So income will be recognized in 2026. They're saying the same thing. Let's take an example of depreciation for expenses. Now let's just say you got a car. You got a car for $50,000 for your business in 2025. In 2025. And that's when the entire cash is paid. But are you using the car only for 1 year? No, you'll use the car for next 10 years. You will use it for 2026, or let's say 5 years. You'll use it for 2026, 2027, 2028, 2029, 2030. You'll use it for next 5 years. So don't you think we should allocate this cost over the next 5 years equally? We should allocate it over the next 5 years equally. And we do it in the form of depreciation, And this is also as per accrual and matching principle. Think about it. Expense is recognized in the period incurred, irrespective of when cash is paid. Cash is paid in 2025. But when did we incur this expense? We have incurred it over 5 years, right? We are using the car for business over 5 years. So it should be allocated over 5 years. And that's what matching is reinforcing. Expenses and losses are matched to the period in which benefits are received. When are we receiving the benefits? We are receiving the benefit for the 5 years. So expenses will be recognized in the form of depreciation over the next 5 years. Doesn't matter when cash is paid. Does that make sense? So accrual and matching. Sometimes a lot of people get confused that are they different? They're saying the same thing. Yes, they are the same thing. They are reinforcing the same thing. They are saying the same thing in two different ways. Accrual is your basis of accounting, which is done as per matching principle. So in a way, they're not two separate principles, they're one principle itself. Accrual basis of accounting is based on matching principle. And we'll use both of this. That's the idea. So accrual states income is recognized when earned, doesn't matter when paid. And we will recognize it to the period in which we have received, in which we have provided the benefits. Similarly, expense is recognized when we have incurred it, doesn't matter when we paid it, and will match it to the period in which benefits are received. These are two principles. The next important principle is monetary principle. Monetary principle states that only events that can be denoted in monetary value should be recorded in the financial statements. Let me explain this. See, what are we trying to keep an account for? First of all, that's the question. What are we accounting for? We are accounting for all business events, all events happening in the business, which have financial value, which have monetary value. And these events, any event which has a financial value is called a transaction, any transaction. And only those transactions to which we can assign monetary value will be accounted for, will be recorded, nothing else. So something as simple as buying a pen worth 50 cents, you can denote monetary value to it. It will be recorded in books of accounts. It will be. But something as significant as, let's say, the CEO of the company dying. Will the CEO of the company dying create financial losses? Will it have a financial impact? Yes. But can you denote a monetary value to it? No, you cannot. Therefore, it will not be recorded. Let's just say workers are highly demotivated. There is a huge demotivation in the workforce. Will that impact productivity? Yes. Will that impact quality? Yes. Will it result in losses? Yes. It will result in lost profits? Yes. But can we assign a monetary value to it? We cannot. Therefore, we will not record it. But anything, even small and immaterial amount, if you can assign a value to it, it will be recorded. It will be recorded. That's what monetary principle states. And it can be a limitation of our accounting as well. We are not able to capture some very significant events because we cannot assign a monetary value to it. And therefore, there's always constant development in accounting. And we'll often disclose these in the notes that we cannot assign a value to it. We'll estimate some value. We cannot record it, but we'll disclose it in the notes so that users are aware. Because the purpose is to make sure we get the users as much information as they need. The next principle which will follow is periodicity principle. Think about it, it's again from common sense. When we maintain any accounts, any books of accounts, any budgeting, anything, it's always done for a period, right? When you develop your budgets for your personal household, you do it for, let's just say, a month, for a week, for a year, right? That this is how much I should spend in a month. It's always for a particular period. Let's just say if I give you $100 every week, if I give my kids, let's just say, or if you give your kids $100 every week, you're going to ask them, hey, what did you do with that $100? What happened to that $100? Can you give me an account from a week to week basis? So it's always for a particular period. So accounting is always kept for a particular period, right? It could be month, quarter, year, doesn't matter. So periodicity principle requires that an entity's life, at a business's life, be divided into artificial periods for reporting purposes, such as months, quarters, or years. So you'll follow a particular period for accounting. The next one is consistency principle. Now, as we discuss accounting, you will realize there will be so many areas. There will be so many areas where there will be choice of alternative accounting policies, where you can choose between one or two methods or one or two accounting methods or accounting policies. So, for example, like inventory valuation, you could use LCM or LCM NRV. We'll discuss this later, right? How to account for, let's just say, tangibles, right? How to account for intangibles. There will be choices that will be there. Now, it's important that when you choose an accounting policy, you apply it consistently from one period to another so that your books are comparable. You can compare how did the business change from one year to another year. You cannot change it every year. That's what consistency principle states. So consistency principle mandates that consistent application of accounting principle, accounting policies is required from one period to another. That's what consistency principle states. Another principle which we have is conservatism or prudence. And before I explain this, I'll take you back. Why are we doing accounting? To inform our stakeholders about what is going on so that they can take business decisions based on it. Why do we do accounting? To inform our stakeholders about what is going on in the business so that they can take business decisions out of it. Now, conservatism or prudence principle states that will inform them of all future possible losses, but not of future possible gains. Right? Will be caution. So, conservatism or prudence emphasizes on emphasizes caution in accounting. So what we are saying is, if there is a possible future loss, we'll tell them now that, hey, be aware we might not have this, we might lose this money in future so that you can make business decisions accordingly. But if there is a future gain, we will not inform them. We'll not record it in the books. And of course, it's more nuanced, which we'll discuss later, but understand the principle in general. And why do we have this? See, think about it. Think from the investor's mindset. If there is a possible future loss, it's not sure yet, it's not certain yet. And if we don't tell them and then the loss happens in future, they're going to blame us. They're like, hey, why didn't you warn us in advance? Why didn't you tell us before? We could have decided what to do with this company. Right? So it's important that you tell them in advance. If it doesn't happen, nobody's going to complain. You told them, hey, this is the worst case scenario. It doesn't happen, they're fine. Good news. Things didn't go bad. But don't tell them of possible future gains. Why? Because if you tell them and if it happens, it's fine. But if it doesn't happen, then they're like, hey, you told me this gain will happen and that's why I invested. But it did not happen. So conservatism states, as per conservatism, all estimated losses, not all, we'll discuss this in detail when we discuss contingent liabilities. Estimated losses should be recorded before they occur, while estimated gains should not be recorded. And it's because of this principle we record your bad debt expenses in advance. If you've made a sale, you're like, okay, I think 10% of it will not be collected. Let's record that expense now. When you sell any product and you think there'll be warranty claims, estimated warranty expense is recorded now because it's a future expense that can happen. If there is a lawsuit you're entangled in and you think you'll have to pay, you'll record an estimated loss today because you are trying to make your investors aware of all possible future losses so that when it really happens, they know they had enough information to act on it, but not future gains. Because what if it doesn't happen? If it happens, nobody's going to complain. But if it doesn't happen, people will. That's the idea. And the next principle we'll discuss is going concern principle. Going concern principles. Now, going concern principle assumes that business will continue to operate indefinitely and will continue forever. So we will keep our accounts as per going concern principle. So think about it. Let's just say you started a business in 1950s as a business and they acquired a piece of land. They acquired a piece of land in 1950, right? Business started in 1950. On 1950, they acquired 100 acre land parcel of land, right? Which was at that point costed $5,000. Today, it is valued at $50 million. But in your balance sheet, in your books of accounts, land will still be shown at historical cost of $5,000. Why? Because the assumption is business will continue forever. If the business is going on, this is the land where your factory is built. Will you sell the land? No. Will you ever receive this money? It might be worth 50 million, it could be worth 500 million. You're not receiving this money because this is where the business is established on. So you will not receive it. So you will record it as per historical cost. As per historical cost, because the current market value doesn't matter, right? That's why all assets are recorded at historical cost, all non-current assets, because not at today's value, because you're not going to sell it, right? Because the assumption is business will continue forever. You're keeping these assets. So what market value is, it doesn't matter. That's what going concern principle is. Now, these are the broad principles which we have: accrual, matching, monetary, consistency, periodicity, conservatism, and going concern. These are the broad principles and framework based on which accounting should be done across the world. Accounting should be done. And we have all accepted it. It's called generally accepted accounting principles. So any company you pick up across the world will use accrual principle, matching, monetary, periodicity. It's based on these. So these are generally accepted accounting principles. Now, every country wants to have its own set of rules for companies to enforce on them, right? And therefore, we have accounting standards. Now, these principles are broad guidelines, are broad blueprints. Standards are specific rules you must follow, which are based on these accounting principles. So, based on these accounting principles, you have repackaged it, explained it more detailed, provided more guidelines, and prepared accounting standards. So you have these principles which are broad blueprints on how accounting should be done. You have taken this blueprint, made it more detailed, right? Provided more clarification for different industries and each and every requirement, and made specific set of rules which companies should follow. Now, for companies in US, they must follow US GAAP, US GAAP at accounting principles. They must follow US GAAP. Now, for European Union, for UK, Germany, France, the accounting standard they use is called IFRS, International Financial Reporting Standards, IFRS, and US GAAP. So these are the two most popular accounting standards that is accepted globally. Now, both are based on these generally accepted accounting principles. They're not very different. They are both based on this. See, think about it. Like, for example, if you're filing taxes in US, you're using Internal Revenue Code, right? If you're filing taxes in UK, you're using tax code of UK. If you're filing taxes in China, you're using tax code of China. Similarly, if you're doing accounting in US, you must use US GAAP. If you're doing accounting in UK, Europe, generally they use IFRS. They use IFRS. These are accounting standards. They are based on accounting principles. So they start with accounting principles, provide more detailed guidelines which are suitable for their own country. Now in US, we must use US GAAP. So every company which is registered in US or filing their financial statements in US must use US GAAP. In Europe, generally IFRS is used. And for the rest of the world as well, they have either using IFRS or they're using an adapted version of the IFRS. So they've taken IFRS as is and they've made certain changes and are using it So US GAAP and IFRS are the most common accounting standards. But again, US GAAP and IFRS are also similar. 95% of the rules are similar. IFRS allows for more flexibility. IFRS offers you more options, right? US GAAP is because US GAAP is designed only for US. IFRS is designed for multiple countries across the world, multiple geographies, multiple tax structures, multiple industries, right? So therefore, IFRS is more flexible and you can choose this. And therefore, some countries might take IFRS, adapt it, and make certain changes and use that. But the most commonly used accounting standard is US GAAP and IFRS. Almost same. So if you're studying US GAAP, assume you know IFRS as well. That's what I always say. There's very small differences. If you need it in your work, you'll always learn it. If you're studying IFRS, assume you know US GAAP. 95% is same. Right? So if you understand basics of accounting, it's same. But in our curriculum in CPA, will only discuss US GAAP, will not discuss IFRS. It's only as per US GAAP. So we have accounting principles, which tells you how we should keep our books of accounts. Based on these accounting principles, we have developed rigorous accounting standards, which are enforced. That these are the specific set of rules based on accounting principles which a company must follow. And based on those standards, we'll maintain our accounting books. We'll maintain our accounting books, which includes journals, ledgers, and trial balance. You might have heard this term, and we'll see today how journals are kept, how ledgers are kept, how trial balance is prepared, all of that. We maintain books. These are the books we record throughout the year. These are the books in which we are recording transactions throughout the year. And at the end, we prepare financial statements. What are these financial statements? You have income statement and statement of comprehensive income. And this is something which you discuss in detail in FAR 2. You have balance sheet, which we will discuss in detail in FAR 3. You have statement of cash flows, which we will discuss in detail in FAR 4. We'll have statement of changes in equity, which we will discuss in FAR 5. And we have finally notes to account, explanatory notes to these accounts, which we will discuss in FAR 6. And that's your entire financial statements. That's your entire accounting universe. It's that simple. Everything we do in accounting is based on these 7, 8 principles which we have discussed. Based on these principles, we have developed rigorous set of rules which are accounting standards. See, think about it. Difference between principles and accounting standards is standards are more specific. It's built on principles. For example, be a good person is principle. But based on be a good person, you have a rule. You cannot cheat. You cannot kill. You cannot lie. Right? All of these are laws that has been made behind the principle that be a good human being. And then you have laws that okay, don't do things which are wrong, specifically listing out. So that's what principles are common, right? They are blueprint, and based on this, we've discussed, created very specific rules which are called accounting standards. And based on these accounting standards, we will maintain our books, we'll record our transactions, and then prepare our financial statements. And that's it. So every transaction that happens will be recorded based on these accounting principles and standards in one of these books, in all of these books, in starting with journal.